definitely be within the timelines. I'll keep it even short. This, friends, is a case where I am trying to touch upon the aspect of permanent establishment. So I am not getting into the fixed permanent establishment. I have again tried to put in some more details in the agreement to create a confusion where the department might treat the assessee in a particular manner. So I'll slowly come on to that one by one. Here is a case where there is a company in US. This company manufactures and markets induction furnaces. It has a lot of subsidiaries, but I am taking two. Initially, we done an internal debate in our organization, in our team. I had taken a number of subsidiaries, but that was complicating the structure on the. It was making it too heavy on the slide. So we've just restricted it to the fact that there are other subsidiaries also, say in Italy and in UK. I've taken Italy and UK because there is some distinction in the treaty as compared to the US treaty. So even these companies, Italy and UK, they also manufacture, in terms of the same technology, the induction furnaces, as is done in XYZ US. The amount, there is a company XYZ India. This company XYZ India has done, I've just tried to analyze the quantum of revenue, that 50% of the income of XYZ India comes from the work done for US, 20 from UK, and the balance 30 from Italy. This again, I have done it from certain words that appear in the treaty, wholly or almost wholly, and that is where this percentage will gain significance, and that is why we've just kept it like this. Now XYZ India enters into a distribution and representation agreement with XYZ entities. So when I said XYZ entities, the Indian company, which is the one down below in yellow, this enters into an agreement. It's a common agreement which is entered into with the various associated enterprises. And this agreement, I've complicated the agreement a little here, that this agreement has both the activities. There are two activities that will now come in the next bullet. I do two activities in India, and both are referred to in the agreement. Only to make it a little complicated, one is I buy and sell spare parts. So that I am doing on a principal to principal basis. XYZ India at a particular arm's length price imports the spare parts in relation to the induction furnaces and it sells. So the entire risk power analysis is, for that XYZ is an entrepreneur. The second activity that it does, and I'll show it to you in the next few slides, where those, again, the granular portion of the agreement will come, and why I have done so I will explain, is the activity in relation to sale of induction furnace. I don't import induction furnaces. So XYZ India is not importing finished goods. It is only importing parts on principal to principal, whereas the induction furnaces are being sold by the associated enterprise directly to third parties in India. Now, with these facts, the complicated aspect now comes. So there are, in terms of the agreement, I am doing two things. One is a direct sale, and in direct sale I am importing spare parts, as I said. I import it at a discount. Importantly is the second bullet. I maintain an inventory of stock of goods. Now the stock of goods is not furnace. The stock of goods is spare parts. Again, when I go to the treaty, the reason why I am introducing this stock is because there are clauses of a permanent establishment to maintain stock and do sales activities. So only to relate it to that, though I do sale activity for the finished product, I import spare part and stock imports. So my revenue is only from spare parts or by way of commission which I get for my sales activities that I do. But this together in one agreement is where I want to state or highlight the point. In terms of the indirect sale, as I said, sale of induction furnaces by the associated enterprises directly to third parties in India for which XYZ earns a commission. Now, here is where, in terms of the treaty that I would be referring to, the clauses that I would be referring to in the treaty, the activities that are done, which are divided by me into two parts. Pre-sale activity. In pre-sale activity, what I do is, all this is there as a part of my distribution and representation agreement. So if I see what activity I am required to do, I am required to do about 20 odd activities or 15 odd activities one by one. So I promote the sale of the product, I help in customer support. The customer support help is, I am a representative of these companies in India. So I have all the material with me, I have all the information as to what all products I prepare, what all products I manufacture, what are the category of products, nature, where can it fit. So if I have to provide this information, I provide this information to the customer. If there is an inquiry from the customer, I send that inquiry back to my head office, so whether it is for XYZ US, XYZ Italy or XYZ UK. I am acting as a medium, a post office, only a center where I collect information from what my associated enterprise tell me or what my customers tell me. I pass on that information from one place to another. That is the pre-sale activity that I do, whether in relation to any category of furnace. And I also maintain records. Now these are points that are stated in my agreement as in terms of pre-sale activity. So I promote sale of the product, I assist in customer support. The customer support could be in relation to inquiry, order, collection of money, anything after that activity is done. And I also maintain that record with me. As post-sale activity, I maintain a sales organization with me. So if one of my associated enterprises sells an induction furnace to a party in India, I help them in installing the product. When I help them in installing the product, that is the part for which I am getting a commission. So if there is a warranty, I am getting a commission. Up to the stage of warranty, I am getting a commission. Whereafter, if I have to enter into an agreement, my agreement is on a principal to principal basis in India, and it has got nothing to do with the associated enterprise. I furnish all the reports that I create, the information to my associated enterprise. I perform administrative functions in the sense that in case I get a customer, I pass on the information that he requires a furnace, say category A. The associated enterprise may ask me what is the credit risk, is the gentleman alright, will he make the payment in time? So in neither of the case am I binding my associated enterprise, that may be kept in mind. So I am not concluding contracts. I will come to that specifically where the clauses of the treaty come. But the purpose, again, I may just repeat it once, why I have brought in pre-sales activity, post-sales activity, because of certain words in the treaty, and that will gain importance. And when I interpret the treaty, how do I interpret that clause of the treaty? Do these activities, which I do majorly, say 20 activities, invoicing, credit risk, customer support, information regarding sales, etc., that I have described in pre and post, do they in any manner touch upon any of the clauses that are mentioned in the treaty? Now in this background, if I move on to the next one, I get the payment that I get is in the form of commission, and the commission may vary according to the risk assumed. If I do only sales activity, I don't take up warranty, I get a rate of commission. This will not have a lot of importance, but only to complete the entire case, we've taken this particular point. The commission income, I showed it in the chart itself. It is divided, my revenue gets divided into 50, 30 and 20. In this background, what we need to examine is the implication of a dependent agency permanent establishment in terms of the US treaty and UK treaty. So I'll be flipping to the sales activity that I have done. I'll be flipping to the slide where the US, UK and Italy come into picture. And so in light of the first question, let us now look at the treaty instead of reading the 2, 3 and 4. We'll go one by one. So getting into the US article, Article 4, Article 5.4 is where the dependent agency PE comes into picture. And the two articles that I'll be touching upon is Article 5.4 and Article 5.5. There are three clauses, A, B and C, you would have read, and they are very simple in the sense that whether you conclude contracts. B is where the sales activity matter, and this is where I would like to read. He has no authority to conclude but habitually maintains in the first mentioned state a stock of goods or merchandise from which he regularly delivers goods or merchandise on behalf of the enterprise. Now this is where the sales activity have an impact, and some additional sales activities conducted in the state on behalf of the enterprise have contributed to the sale of goods or merchandise, or he habitually secures order wholly. The percentage of 50, 30 and 20 is where wholly or almost wholly for the enterprise. So why I touched on the sales activity is clause B, and 50, 30, 20 is on account of clause C. I'll very quickly run the 5.5 also. An enterprise of a contracting state shall not be deemed to have a permanent establishment merely because it carries on a business through a broker, commission agent or another agent of independent status, provided that such persons are acting in the ordinary course of their business. That's the first point. However, when the activities of such agents are devoted, if you relate the clause B wholly or almost wholly on behalf of that enterprise, and the transaction between the agent and the enterprise are not made at arm's length. So even in terms of permanent agency, I am wholly or almost wholly doing it. But if I am at arm's length, the question of dependent agency PE will not arise in case of US. It is simple. The only point here is that this 5.5 gives you a twin condition which have to be simultaneously be complied with, either of which, if not complied, I am out of the dependent agency PE. If I examine the implication of a dependent agency PE under the following treaties in terms of US, and I see my facts in terms of the sales activity that I do, I would wish to argue that irrespective of whatever activity that I do, they may be 20 in number, 5 in number or 50 in number, enumerated in my agreement, it will not be a case of a dependent agency PE if I do not strictly come within clause A, clause B or clause C of Article 5.4. This is simple. Why the entire thing is, as an Article 5.4 have I to strictly read that none of my sales activity, whether I do it for my AEs, falls in the clause A because it does not lead to concluding of the contracts. It does not lead to the stock along with activities. Now, the stock that I maintain is of spare parts because that is what I am buying on principal to principal basis. I am not maintaining a stock of induction furnaces, neither am I supposed to maintain that. So even if I maintain a stock and deliver goods on behalf of the word is on behalf of the enterprise. I do not do it on behalf of the enterprise. So to the extent I maintain stock of spare parts, it is my risk. I am the principal. I am the person who's bought it. The debtor risk is mine. The marketing risk is mine. Everything is mine, and I do not I do not deliver it on behalf of the enterprise. that is my associated enterprise. I deliver it on my behalf when I sell it to the consumer in India. So in none of the situations in regard to US do I get covered by a dependent agency PE. Coming back to UK and Italy, there is slight distinction in UK and Italy. I have not touched upon this aspect of securing orders in terms of the protocol which now appears on the slide, because this august audience would be aware of the fact as to the Indo-US protocol defines what securing of order is, and in terms of that, these are the conditions that have to be complied with: 1, 2, 3 and 4, where frequently accepts orders, substantially all such persons sales related activities in the contracting state consider activity of the enterprise. My sales activity is in relation substantially all of the sales related activity. My activity is not only divided into two between spare parts and induction furnaces, but it is also not substantially for any one of the associated enterprise. So protocol was just given to define what securing orders actually is. Coming to the UK treaty, if you see clause A and B, clause A and B are similar to what the US treaty defines, but clause C is slightly different. Clause C says he habitually secures orders in the first mentioned state wholly or almost wholly for the enterprise itself or for the enterprise and the enterprises controlling or controlled by, subject to the same common control as that enterprise. Now here, as compared to the US treaty, the distinction is there it is a case of aggregation. Here in US it is not a case of aggregation. Aggregation would finally lead to one of the questions that we would be examining in our case study is force of attraction. That is where there are other aspects which we would be looking at, but this aggregation, do I do wholly or substantially? That word almost wholly, wholly or almost wholly and substantially, I get caught when I read clause C of both the UK treaty as well as the Italian treaty. Because if we go to the Italy treaty, this is the UK treaty which has clause C, and similarly the Italy treaty has exactly the same clause where he says secures order in the first mentioned state wholly or almost wholly for the enterprise itself and for the other enterprises. Now the important part comes when we have to examine the India-UK and India-Italy treaty as far as dependent agency PE is concerned. Now US, as I said, I do not get covered because either I have to comply with 5.5 where my product, my TP regulations, I am not at arm's length, I get caught, or I get strictly caught when I get covered by the three clauses A, B and C. But in case of Italy, if we see clause 5 or UK, they are the same. I'll just take the UK part. An enterprise of a contracting state shall not be deemed to have a permanent establishment in the other state merely because it carries on a business in that other state through a broker. Till the word business, the language in the three treaties is the same. In this treaty of UK and Italy, the distinction comes here. However, if the activities of such an agent are carried out wholly or almost wholly for the enterprise, and then they repeat what clause C says, he shall not be considered to be an agent of an independent status for the purpose of this paragraph. What misses out here is the second condition of the Indo-US treaty of the transaction being at arm's length. So if I am trying to get covered, if I get covered somehow or the other in terms of the dependent agency PE as Article 5.5, I still need to be covered by Article 5.4. So I may assume myself to fall within the definition of a permanent establishment in terms of 5.5, but if I do not secure orders, if I do not conclude contracts, if I do not maintain stock, I would still get away from having a dependent agency PE in terms of the UK and the Italian treaty. So the distinction arises if I conclude it treaty-wise. In terms of US, I have to get covered by these three clauses of concluding contracts, stock, and the other one, the last one, securing orders. In addition, if I go to 5.5, even if I do it in the ordinary course of my business, if I comply that there is a situation where my transaction is at arm's length, I get out of both 5.4 and 5.5. In case of the UK and Italian treaty, if I look into it, even if I get captured by 5.5 under the UK or the Italian treaty, I need to get out if I am not securing orders or if I don't comply with 5.4 and 5.5. The only distinction being that here, for wholly and almost wholly, it is a concept of aggregation which is not there in the case of US. This may not seem to be very interesting, as I thought the first one was very interesting. The second question, I have tried to add up a few things. In the above scenario, considering India-US treaty, would it make any difference if XYZ India maintains stock of induction furnaces and 50% of the sales related activities of XYZ India in India consist of activities for XYZ? Now, the distinction that I am bringing it here is, as I told in my facts, I am dealing in spare parts, I maintain stock of spare parts, I don't do anything for furnace. The moment I maintain a stock for furnace, I get caught and the situation changes. So in terms of the Indo-US treaty also, I will then fall in clause B. He has no such authority but habitually maintains in the first mentioned state a stock of goods which he regularly delivers on behalf of the enterprise and some additional sales activities conducted in the state on behalf of the enterprise. So if I go to my questions, and if you see the question 2, question 2, bullet 1, if XYZ India maintains stock of induction furnaces and 50% of the sales related activities of XYZ India consist of activities of XYZ, in such a situation, in my opinion, there would be a permanent establishment of the US entity in India. Will the response to the above change if there are no sales related activities? Yes, it would change. Then I do not comply with the complete part, clause B, because I only maintain and deliver stock, but I do not do the additional sales activity. So in that situation, I will not fall in the permanent establishment. This is something which we just thought to make it a little more interesting. I was not able to personally conclude as to which way to go, but I'll surely put it across to this audience to consider. If in case of US, the US sends 2 employees to India from 1st of April to June 15. So I don't complete the 182 days or the 6 months period for clerical and managerial assistance related to documentation of tenders of orders with Indian customers. So in a manner, let us conclude for or assume for a moment that when these 2 people come for that short period, they conclude contracts. Now, in terms of concluding contracts, can an employee, the interesting question I feel is in 2 parts. Can that employee be considered as an agent of the company? So if I'm a sole proprietor and I come myself and I conclude and I go back, can I be my own agent? Or is it a situation that the entity and the employee are to be taken as one, or they are to be taken as 2 separate entities? The moment we consider the employee as an agent of the company concluding contracts, I fall within the definition of a dependent agency PE, and I cannot run out of it. But if I am able to argue that the same ratio which can apply to a sole proprietor, when he comes and does it, does he become his own agent? Then there is no case of a dependent agency PE. But I was just running through a few articles, and I did come across both favorable and unfavorable parts. The OECD commentary makes a distinction between an employee and a dependent agent. There are certain Indian commentary, and specifically if you want to see, this commentary is by Venkoba Rao, 3rd edition, on page 92 of their book called Law of Agency. They have made a statement, let me just read it out for you. An agent is not a servant, but the converse is not true. An agent is not his master's servant, but a servant is his master's agent for all practical purposes. And if a servant is entrusted by his master to do certain things, he is to that extent an agent of the master. So, if you are able to put it across that that employee is not an agent, we are successful in arguing. But as Rajan Bhai was earlier referring, we are litigators, and I especially, I consider even Rajan Bhai and Sunil, we are irreparable optimists. So we should also always consider ourselves putting across something which is only in favor of the assessee, and we can't think about the department. So as I said, OECD has also made a slight distinction, and they have said persons whose activities may create a permanent establishment for the enterprise are so-called dependent agents, that is persons whether or not employees of the enterprise. So there are two thoughts, and that is why I thought of introducing the third bullet of make it slightly more interesting by bringing in an employee and concluding the contract. The third question is force of attraction rule. Now the question of force of attraction rule, as to what I understood, was, if I read Article 7, by mistake I have not been able to capture the Article 7 of the US and UK, but I have it on with me, I have the hard copy. The aspect of assessing a permanent establishment in terms of the other related activities, the other related business, and then assessing it in India should arise only in a situation, if this audience just looks at clause C, because what is to be attributed to India in terms of that is other business activities carried on in the other state of same or similar kind as those effected through the permanent establishment. Now if I am doing three activities, I am maintaining stock, I am selling spare parts on principal to principal business, on a principal to principal basis, and I am not stocking furnaces, then I am not doing same or similar kind of business activity which is being effected through the permanent establishment. The business activity that is being done through the business establishment is of spare parts and furnaces, neither of which are same or similar, and if I do not fall within this, then there is no question of a force of attraction rule, whether it is in terms of US. In UK and Italy, instead of 7.1, the same information gets described in 7.2 in slightly different words. Let me not take time on that aspect. That is where, till the time, what I wanted to emphasize in the case study was, if it is not same or similar goods, spare part vis-a-vis the induction furnace, then there is no question of the entire thing getting aggregated at one place and the permanent establishment being taxed for the entire activity. The last question is very simple, and the answer is simple. examine the attribution of profits considering XYZ in India is compensated by XYZ US at arm's length. Now here we have a Morgan Stanley decision. I can still discuss a few negative thoughts that did arise in one of the discussions that we have, because we don't have departmental people here, so it's safe to put it across here. There is a thought that what Morgan Stanley states, Morgan Stanley, and please correct me if I'm wrong, that was a thought that I had, and Sunil, please, on that point, is it says that if the establishment in India has been remunerated at arm's length, then no further attribution is required. Now let me give you an example to just give a devil's advocate view of what can happen. Say a particular product like a pencil is sold for 1,000 rupees, which has a profit of 450 rupees. So that's 45% income that the US company is earning out of 450. And out of that 450, 200 rupees has been given to the Indian entity. And that 200 is considered to be at arm's length, attributable to the FAR analysis and activities that I have done. OECD possibly, Rajan bhai, do correct me if I am wrong, I have not read it, but somewhere I did, I have not read the OECD commentary as such, but I surely read some article where I got this thought, and we've been internally debating within the organization, that ultimately the sale has of this pencil for $1,000 or $1,000 has taken place in India, which has finally led to an earning of income of 450 rupees, of which 200 has been taxed. What about 250? Should I not consider the activity of the permanent establishment as a separate entity, and some part of that 250 that has gone to US should also be attributed to India? That's my question for your thought, for your consideration, that if the department takes up, and I'll leave it to the chairman to answer it subsequently, that in spite of the fact that Morgan Stanley does say that 200 was at arm's length, was covering all the activities, but it does not cover the activity of sale. It covers what 20 rupee or 200 rupees that they have incurred is the activity to do that sale, but the sales activity as such has not been covered. Should India lose the tax on that sale activity of 250 rupees, or should something of that also be attributed to India? That could be a thought which can go against us, and we need to consider that. Rajan bhai. Thank you,
Kanchun, for elaborately discussing the PE part and also the attribution part. No further thoughts. I think we have already covered exhaustively. Just word of caution, as you rightly pointed out, we need to take into account. We have to see when we talk about permanent establishment or business connection, we have to start always from the R.D. Agarwal's decision 58 ITR, right up to go to TI's case, and where there is a question of even canvassers and then after sales service, and how the courts have looked into. I think those tests need to be very, very carefully looked into. Treaty definitely helps us wherever the treaty helps, but if you are formed in a non-treaty country, then you need to take care. So this, starting from R.D. Agarwal to TI Industries case, and these are the cases we need to take into account. There are two decisions I think you could have a recourse to. One is that variant, which is, I think, again argued successfully by Kanchun himself. It is reported in the 142 ITD 692 Mumbai Tribunal decision. And another old decision you can find similar way in case of Daimler Benz, where they were selling the spare parts and selling also the goods directly to the customers. How this has been looked into by the tribunal to give some view. So this is the point, and very clearly many times we make a mistake of definition between interpreting dependent agent versus independent agent. There are very, very fine distinctions made, because dependent agent starts with those who are not independent agents. So therefore we need to carefully look into whether I fall in dependent or independent agent first, and then see the satisfaction condition. We try to intermix the condition on our common understanding, and then we fall in some trap. So therefore, be careful while interpreting it. Now coming to the second part, what he mentioned about regarding force of attraction rule. When the spare parts are imported which are sold for the servicing by me only, I am canvassing the goods, I am collecting the money, will department try to litigate? I think we have to build our case, documentation properly to ensure there is no activity connecting to sales happens in India or by Indian company. So because otherwise sales force of attraction rules gets attracted, then TI cycles observations come in the picture. So therefore we should be cautious, and as I rightly said, all those will depend on your documentation. Many times what the department is trying to do, they don't stop on the basis of your documentation. Recent cases, even in cases of AR, there have been actual surveys have been carried out by the department on the assessees to find out what is the activity carried out by him. They have seized their hard disk and found out what is the correspondence happens. And many times these agents, not only canvassers, many times we find everything is concluded by him, only the order forms comes from signature from there. And there we'll end up in problems. So what is crucial is your documentation, your hygiene of your transactions. Otherwise if we try to do, because when the survey happened and the state people were examined, they were examined and they said we do the sales, we do the client, their income or the commission was based on what is the sales made in India. So therefore all these facts put together gets into different tangents. So therefore we should be very careful. The last point which Kanchun rightly mentioned is regarding attribution of India. I fully agree with him. In fact, if you see the Sony India's decision, Morgan Stanley was first, the Sony India was Bombay Airport, which is later decision, summarily says since there is no transfer pricing adjustment made in India, therefore we feel that this is arm's length, nothing further to be attributed. I think, as you rightly point out, I fully subscribe to you. There need to be far analysis to find out whether there is a proper analysis done to the attribution of income, because ultimately if you are held to be a dependent, you need activities what are carried out, what is income attributed to that. So therefore that need to be very, very carefully seen. And Sony India, if you read, you will get this what he mentioned. And we feel, Sony India needs to little go further. What will happen Supreme Court, nobody knows. So therefore these are the points I think we will do. We will move now to the second case study of Sunil. My request to both of you is we need to little hurry up. We are already little behind schedule. So in 45 minutes we have to finish 3 case studies. Sunil and Kanchun.
Thank you, Rajan. So coming to this BP study, I made just 2 changes here. In the case study which is before you, the AE manufacturing sales is mentioned as 80, we've reduced it to 70, and the non-AE has been reduced to 30 as against 40. There was some typo errors, but it's not of any significance. So here is a case where the particular assessee does both the activities, manufacturing and trading. In manufacturing, he has AE transactions where he has a unit where the entire sale is to an associated enterprise, and then you have non-AE manufacturing segment also, and then you have trading transactions wherein there are some sales to AEs and there are some purchases from AE. So other than the middle column of the non-AE, both are international transactions, manufacturing AE segment as well as the trading segment. This is the final working by the assessee. So if you would see in the manufacturing segment, he is having a margin of 16.67, which is more than the comparables margin, which in this in the facts of our case. And in the trading also, he is having a substantially good margin of 36%, more than the comparables margin. However, the non-AE segment has not done well. It has incurred a loss, and overall, the assessee has incurred a loss with a negative margin of 19.58%. These are the facts of the case. In this, if you see the AE column, that is 70, let's call it 70 crores there, and the AE column, this entire 70 crores revenue is from my associate enterprise. If we go to the trading column, the 15 CR total revenue, out of that, 3 CR has been sales to associate enterprise. These are facts mentioned in the earlier slide and in your case study. And if we see the operating expenditure in the trading column, out of 11 crores, 2 crores are imports from associate enterprise. So we have 70 crores sale entirely in the manufacturing segment to AE. We have out of 15 crores in this trading segment, 3 crores to AE, and in the operating expenses out of 11 crores, the trading segment, 2 crores is import from AE. These are the three issues here, three important points. And also in my segment, I have reduced a rental income of 10 CR in my manufacturing segment. So clearly speaking, this AE, this 10 crores belongs to, there's some vacant area in next to my factory, some premises are there, and I've earned certain rental income from there. It's clearly coming under the manufacturing segment, but this is what I have reduced. The AO says that, look, you incurred a huge loss, and I believe that this must be towards your AE transactions. I am rejecting your segments. You have manipulated the segments. As a result, that you're just putting the loss in the non-AE transactions. I will go by an entity level, and if you see majority of your transaction, your full AE transactions in the manufacturing segment is there vis-a-vis AE. In trading also, you're having both purchases from AE, sales to AE. So by and large, there is a substantially AE driven company, and therefore I will take the overall margin. I'll reject your segments. So when he does that, these numbers which he has taken are my own numbers. So there is no dispute on this operating revenue of 115 crores. There is no dispute on the operating cost of 143 crores loss. There is no dispute on anything. 20% is the comparables margin which he has taken on updated margins, which we are accepting. And ultimately, he makes an adjustment of 56 crores. This is what he has done. Our first, I'll come to this a little later. So issue for consideration really is whether the TPO is right in disregarding segmental working, and assuming for a moment that I have some flaw, some deficiency in my segments, some things I cannot substantiate. In that event, what should be the adjustment? These are the first two issues at the moment. I'll come to letter of comfort a little later. Now, if really one goes to 92.1, 92.1, as we all know, talks of arm's length price in relation to an international transaction. Even if you go to the rules talks of arm's length price in relation to an international transaction. And even if we go to OECD, I'm referring to 2.78 para, it says an appropriate level of segmentation of the taxpayer's financial data is needed. Therefore, it would be inappropriate to apply TNMM method on a company-wide basis. So clearly the law helps us to say that the entity level addition is clearly wrong. And these are the three decisions where it has been held that I think maybe one of them could be argued by you. There have been some argued by Rajan Bhai on this point also, that segments must be accepted. However, there may be cases where I cannot substantiate the way I have allocated my expenses. Maybe I cannot justify certain expenses, etc. Maybe there are certain deficiencies in the book which may practically arise, which may lead the AO to reject my segments. And though legally he must accept my segments, let us take a practical situation that he has rightfully rejected my segmental accounts and therefore made the adjustment on the basis of my figure on an entity level. In that event, what should the addition be? Now, you all must be wondering, why have I taken this illustration? There are plethora of decisions which say that the adjustment cannot be vis-a-vis the company margins, it has to be vis-a-vis AE. And there are a number of decisions which have sent back the matter to the file of the TPO. So, I have come across, I would say, almost all cases where the matter is set aside, except in the case of Alstom, the first one. This is a case where the tribunal actually took into account the computation made by the assessee, and on the basis of that computation, reduced the adjustment to about 20% or so in the facts of this case. So, what I want to urge to this audience is that very often when you take the plea that the adjustment must be on the basis of international transaction and therefore let the matter go back for proportionate, I think it may be worthwhile to do the exercise of giving the proportionate working. So if we have to give the proportionate working, this is how it will come to. And I'm sharing this with you because I have, in some academic discussions, some members have mentioned that very few people are giving the working of the proportionate adjustment to be made therefore all the matters are getting set aside. Whereas if you want a real conclusion in the tribunal, an attempt may be made to give this kind of a working. So let's say if the adjustment is 56 crores determined by the TPO, then in this particular case, there are AE transactions in the manufacturing section and there are AE transactions in the trading segment. First, we must decide as to what is out of 56 crores attributable to the manufacturing segment and what is attributable to the trading segment. This, if we apply a simple proportion, that is, we take the AE manufacturing sales 70 upon total sales 115, whatever we get is 32 crores is towards the AE segment of the manufacturing. So this will be the adjustment on account of AE, since the entire AE segment is, since the entire AE manufacturing goes to AE, this entire addition would be on account of AE transactions, 34 crores. Now when we come to the trading segment, the addition comes to, on a similar basis, 7.42 crores, which is you take 15 crores of the trading revenue upon total revenue 115 into 56.87 crores, the adjustment. That comes to 7.42 crores. And at this stage, the TPO often says that look, in your trading segment, both your sides, you're purchasing from your AE, you're selling to your AE, it is tainted on both sides, and therefore even if you go by this 7.42 crores should be added on account of your trading segment, since it's tainted on both sides, purchases and sales. The working which we can do further for 7.42 crores is, if I'm having if an adjustment is to be made, then it can be for two reasons. Either my sales are less or my purchases are more. So let us say what can be the adjustment which can be attributed to sales and what can be the adjustment attributable to purchases at a gross level. So if we look into this particular illustration, my operating income is 15, my gross revenue is 15, my operating cost is 11. Therefore, if I take a proportion of 15 by 26, then you can say that 4 crores, if at all, if my sales have been undervalued to the extent of 4.28 crores. Similarly, if we do for the purchases, the answer would be my purchases have been inflated to the extent of 3.14 crores. And that's how one would really break up the 7.42 crores into 4 and 3 on account of sales and purchases respectively. Now, but it doesn't end here. Again, if we go to the sales part, out of 4.28 crores, out of my total sales of 15 crores, only 3 crores is towards my AE. So assuming my sales are deflated to the extent of 4 crores, the entire 4 crores cannot be towards my AE transaction, which is only 3 crores. Therefore, one would again do a proportion here or vis-a-vis the 4 crores. And the proportion for 4 crores adjustment would be 4 crores, 4.28 crores into 3 crores AE sales upon the trading sales 15, and the adjustment would really come down to 0.86. Similarly, for the purchases, if one was to do this, the number would come down to 0.57 and the 7 crore adjustment would really come down to 1.43 crores. Now, this is a working which may be logical but elaborate. And if really one wants to do the same simple working, we have this chart. So one may not be able to appreciate the logic here, but the same number comes here, which is 1.43. And that is, you take the entire sales and purchases vis-a-vis AE upon sales and purchases on the whole, and that proportion comes to this. Now this is, I'm mentioning this because if you will see, most of the judgments are merely setting aside. And there is no mechanism given as to how it should be computed, and I would think this is one of the ways one could compute it and reduce the addition substantially without a second round before the AO. The other adjustment, the other allegation of the AO is, he says you have made an adjustment in your margin by the extent of 10 crore, which is your rental income. And he says if you go really by the section and the rules, if you really go by the rules, then adjustment can be made only vis-a-vis comparables. So how are you making an adjustment vis-a-vis the assessee itself? That is an objection which is often raised by the TPO. Here it is rental income, it could be idle capacity, it could be whatever. But the answer for that, the answer here would apply for the answer for everything. Really, what does the rule say? Yes, he's right when he says that the adjustments have to be vis-a-vis the comparables. But what does the rule say? The rule says net profit margin realized by the enterprise from an international transaction is to be computed in relation to cost incurred or sales effected. You have to keep that in mind. So let us say if there is a cost which as such is not attributable to your AE transaction, and one can have even an idle capacity cost, where in an appropriate case you may want to take that adjustment vis-a-vis a comparable, but you can also by virtue of this rule make an adjustment in your profit itself, in the assessee's margin. So if really one goes by the rule, there is an indirect way to make an adjustment in your margin of the SSC itself. As regards the decisions on this point, we have a Mumbai tribunal decision which is contrary on this issue, but there is no discussion. It merely says, as per the rule, the adjustment must be vis-a-vis the comparable. And we have another tribunal decision which takes into account the rule and says, no, this adjustment can be made vis-a-vis the SSC's margin also. Ultimately, the higher courts would decide, but my view would be that if going by the rules itself, there is scope to make adjustment vis-a-vis the SSC's margin itself. Now we come to the 3 letters of credit. Now in this particular case, we have given 3 letters of credit. The SSC has given 3 letters of credit to the bank, and the bank in turn will give the loan to my associate enterprise. The first letter says, before liquidating, I shall let you know. So I am telling the bank, before I divest, I will let you know. So the bank is comforted. Okay, you are a well-reputed parent. At least you will let me know when you are liquidating. Then I can take appropriate measures. The second letter says, I shall seek your permission before liquidating. So please give the loan to my AE. I am comforting you right now, and I will always be there as a parent. But I shall seek your permission before I liquidate. And the third letter of comfort says that I shall cause my associated enterprise to be in a position to repay you back. Now, as far as the banks are concerned, different banks have different ways of accepting their level of comfort. So we have taken a case, again the live case, where these 3 letters of comfort have been given. The TPO says, no, the letter of comfort is nothing, it's a different form of a guarantee, and therefore I will make an adjustment of 3% of the amount of loan which the bank has given to your associated enterprise and make an adjustment therefore. Now, let us say for a moment, and here I think one of the precedents case in this on guarantee I think was set up by Rajan by itself, wherein the tribunal held that guarantee is not an international transaction itself. So prior to the current law, the tribunal had held that guarantee is not an international transaction, and if one was to apply that law to the facts of our case, one would say obviously no adjustment should be made. Thereafter the law has got amended and guarantee has come within the purview of an international transaction. However, that's a guarantee and we are talking of a letter of comfort. Now let us see what happens in guarantee and whether a guarantee can be called a letter of comfort. What's the allegation of the TPO? If you go by the Contract Act, 126 of the Contract Act, it says a contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. Now here, none of the letters of comfort say that if the AE does not pay you, I shall make good you the payment. So really, if you go strictly by the Contract Act, it's not a guarantee. And even if one goes by the dictionary meaning of Stroud's and the law lexicon, the definition of guarantee is a collateral engagement to answer for debt, default or miscarriage of another person. A guarantee is a promise to another as creditor to secure the payment of a debt payable to him. And law lexicon says a promise to a person to be answerable for payment of a debt or performance of a duty by another. So clearly our letter of comfort is not a guarantee. Now the letter of comfort is also defined in the dictionary, which says a document that indicates one party's intention to try to ensure that another party complies with the terms of a financial transaction without guaranteeing prompt performance in the event of default. On the basis of these dictionary meanings, it may be possible to argue that a letter of comfort is not a guarantee and therefore the TPO is wrong. However, an issue may still arise that when I am taking on an obligation, I am saying I will not dispose of my assets unless I seek your permission. It's a transaction which will have an effect on my assets or liabilities, because the moment I am saying I will not dispose of my assets, I am giving a particular commitment. There can be an opportunity loss for me and I should be rewarded for it. The moment I say that I shall cause my associated enterprise to be in a position to repay you, I am taking on a responsibility to ensure that my AE is in a position to pay you. So I'm saying instead of me paying you, I may pay my AE who in turn may pay you. And therefore these letters of comfort, one may say that though it's strictly not a letter of guarantee, it is akin to a letter of guarantee. And if not akin to a guarantee, it's an international transaction because it is going to have an impact on your assets, liabilities, whatever. And there is scope to say that. If that be the case, and there is no really decision available on this point, The answer would be, really, can you call a letter of guarantee an international transaction itself? Because if a letter of if a letter of comfort is not an international transaction, and obviously it's not a guarantee, then no adjustment should be made, notwithstanding whatever hypothetical impact it may have on my assets in subsequent years. So the argument really would be an international transaction is a transaction between two or more associated enterprises. A letter of comfort is given by the assessee to the bank, which is not an associated enterprise, and therefore letter of comfort is not an international transaction. The department would argue, well, the same applies to a guarantee, because guarantee also you give a guarantee to a bank. How is it an associate? How is it an international transaction? But in case of a guarantee, under section 140 and 145 of the Contract Act, there is an implied promise. This is the language used in the section. There is an implied promise by the principal debtor, which is the AE, to indemnify the surety, which is the assessee, and the surety is entitled to recover from the principal debtor, which is the AE, whatever sum he has rightfully paid under the guarantee, and the surety, which is the assessee, is invested with all the rights which the creditor, that is the bank, had against the principal debtor. The law itself says there is an implied promise. So though my guarantee says I shall pay you good, the default if my AE doesn't pay you, and I don't have, so to say, a right on my AE in that particular document or the agreement, section 140 and 145 of the Contract Act says there is an implied promise that the AE would have to do you, make you the payment to you. And this implied promise, and once there's a promise, there's a transaction, therefore there's an implied transaction in case of a guarantee, which is missing in the case of a letter of comfort, because there is no law governing the letter of comfort. So if really and also now guarantee is covered under explanation 1C to 92B. So really speaking, one can argue that this is not an international transaction. The counter of the department could be that, well, maybe it's a deemed international transaction. Now, a deemed international transaction is a transaction between two non-associated parties, as in our case, provided, and this is the in quotes part, the third last bullet here, if there exists a prior agreement in relation to the relevant transaction between such other person and the AE, or the terms of the relevant transactions are determined in substance between such other person and the AE. And the department may argue that there is a prior arrangement your AE has with the bank, that on the basis of the letter you give them, they will be paid the particular amount, and therefore there is a prior agreement. Now the answer for this is, there are two decisions of Kodak and Development, two tribunal decisions, wherein they have held that the object of this deeming international transaction is only to prevent tax evasion. So let's say if I want to transfer some profits outside of the country to my AE, I'll be hit by transfer pricing provisions. So what I would do, I would introduce a third party which is not connected to me, and I will sell goods worth 100 rupees at the rate of 20 to him, and there would be a prior arrangement between that X and my AE, who would sell the 20 at 30. Yet I have transferred profits outside of India. So when this third parties comes in with a view to evade tax, that's when deeming provisions have to come in. That is the object of the deeming provision. So if you really go to the particular circulars, and the object of the deeming provision is to avoid tax evasion. Now when there is a transaction between a bank giving loan to an AE, obviously it's a commercial transaction there is no tax evasion in it. So if one gets out of 92B, because that is the object of 92B2, really speaking, one can argue that a letter of comfort is not an international transaction. Assuming for a moment this transaction has some bearing on my assets, one can even argue that when I say I shall cause my assessee to be in a position to pay the money to you, and maybe that happens after 3 years, and after 3 years I may give my AE certain money at arm's length interest. I may want to invest in my subsidiary for whatever reasons. So one cannot say at this stage, first of all, that there is an international transaction, and two, in subsequent years there will have a bearing on that. And even if you allege that in subsequent years there may be some bearing on your assets, the fact of the matter is, one can argue it's not an international transaction, but this has to be tested. There are no decisions on this particular point. And I think with that I cover my...
Thank you, Sunil, for excellent coverage. Only two quick points. As he rightly put it, as part of the tested party, adjustment to be made in the tested party or the comparables. Very, very rightly put it. This has been a matter of confrontation with the tax authorities. But the way we had similar matter, we were able to put it. If you want to compare like to like, if I have rate, is a comparable company has a rate. If comparable company doesn't have rate, where will you make adjustment to? So definitely you have to make adjustment to my profit, otherwise it doesn't make comparable. As Sunil rightly read out, if we read the rule again, we get this answer. So therefore this is possible, and the same basis we have been able to do capacity utilization. Same exactly, and there are a number of decisions now on capacity utilization. I am working at 20% capacity. I have just entered the production field or market. Comparables you are using for the established companies with 50 years of establishment who have a production capacity of 90%, achieve the capacity 90%, then can you compare the like to like? And the tribunals have given the capacity adjustment, so in different way you get the same benefit. And the capacity adjustment is you can do it in my case or you can do it in comparable case. Because ultimately you have to make comparables. And that has been accepted by the tribunal. So that could be supporting what Sunil said. I think we need to take into account. Now, the second point which he rightly mentioned is regarding the segmental versus entity level. I think that there are a number of decisions, as he rightly pointed out, but the Technimont and the UCB was the first decisions where they have categorically discussed what is meant by segmental and what is meant by entity level. Because if you say TNM method, when we apply, and again I think we have to be very careful, when do we apply these terminologies? Cup method, TNM method or cost plus method. So we have to use this terminology only in case of TNM method, and therefore you need to see at the transaction, what it talks is transaction net margin method. So though it talks about transaction, you don't have to go by transaction, but at least you see this case, they have diluted down to say transaction means segmental is also a transaction. Transactions of a similar nature, if we have to compare, it is a segmental transaction we need to be considered and not the entity level. So therefore that has also been accepted, and these are the decisions which have laid down some principle and which has been followed in the all subsequent decisions. Sunil rightly mentioned is regarding the documentation. I think there we lack, and therefore all these cases, if the documentation is weak and the segmental is not given in your TP study, then it becomes a challenge for you to get it set aside, even set aside for the tribunal. If you for the first time you bring it segmental and then you say that this is what is audited by a third chartered accountant and which you are producing, which tribunal or the appellate level authorities are not prepared to accept. So therefore when you make the documentation, please ensure that all these facts are on the record right from the TPO stage. If not TPO, at least improve upon when it goes to CIT appeal or DRP stage, calling for report from the assessing officer that TPO, it will help you. So this becomes a crucial, as is rightly said, most of the cases are set aside because documentation was not proper or the facts were not proper on the record. And it is always better to place these facts with the, even at the additional evidence before the tribunal, get it set aside but with this additional evidence. That becomes helpful because that is not the first time produced before the TPO. You have produced before tribunal, after considering that these are some merits in that, they have restored back. So that becomes helpful when it goes to the appeal. The last point is regarding the guarantee. I think very, very rightly raised, and as I said, in Forsoft case, that was the first case which was before amendment, we had succeeded, there is not a guarantee. Similar issue came up later on in case of Everest Canto, which had appealed to argue that matter. There also we took the point exactly Sunil mentioned. Though we have said you are invoking the retrospective amendment vis-a-vis the transaction. Transaction has happened earlier, can you invoke this retrospective? Though the law is retrospective, how can you invoke saying that this transaction would be deemed to be an international transaction at the relevant point? They didn't give finding, but this is what need to be developed. Second point we need to consider, either as I said, letter of comfort. Second is the corporate guarantee and bank guarantee. There are three different aspects we need to dissect. Because as I said, each bank has its own procedures. If we find there are many times you get much more beneficial views if you try to analyze this terms of these agreements, and you get much more benefit to go through that. And again, as I said, we need to really consider not only that guarantee is given, but is there any benefit derived by this guarantee? If your PLR rate or prime lending rate in that country is lower than the rate to be charged, where is the guarantee given? What is the benefit given by you? Ultimately, adjustment is for the benefit given to the E. If your rate is higher than the PLR rate, where is the benefit given to you? So therefore, if that is the condition, then again it will fail on the competition mechanism. Principally you may be right, but ultimately there is no benefit passed on, no adjustment could be made. So therefore that also need to be considered. And the point is, what is the guarantee? It is, if 100% is owned by me, here it is 60%. If 100% owned by me, my whole stakes are at full investment is at stake. Full investment is at stake. That itself is more than guarantee. What else do we need to give a guarantee? If tomorrow company fails, my entire investment is going to go down the drain. So therefore, that is also argument which has been considered and has been considered by the in most of the decisions. These aspects has been considered. So therefore, as I rightly said, I subscribe to all the views what Sunil said. These are additional thoughts we should consider. Friends, now we'll have 2 more case studies, but I would request both of them to 10 to 12 minutes so that we'll be able to finish it on time.
Same promise as we do in the tribunal when we have a good bench. We say we'll do it in 5 minutes and we take 45 minutes. But I assure you I'll take 7.5 minutes and I'll finish. This issue of marketing intangibles, I will not take much time. The special bench is already against us. But the thoughts that have come to my mind that in spite of the special bench being against us, what are those aspects which the special bench has not considered? Maybe considered in the sense referred to but not concluded. So what do we need to say in excess of what already LG says? Friends, as far as the gut feel comes, as a litigator, many a times you feel, kya ye aisa ho sakta hai? Can it happen? So that is how you start proceeding in a case, and I have experienced people that you would be feeling the same. My gut never says that this marketing concept of marketing intangibles that has been introduced and this concept of bright line test, how does it lead to an international transaction when you are getting the services paid in India to an XYZ India Private Limited? So a payment in India, how is it an international transaction for the associated enterprise? But as they say, the deeming provisions take you to a logical conclusion. Now, what is a logical conclusion and how far do you travel is where this concept got created of marketing intangibles, that you do something here and it benefits there. Now, LG does say it benefits, but how does it benefit? What is the tangible benefit? How would you compute the tangible benefit? It's actually to guess. Now, very quickly coming on, I promised 7.5 minutes and I'll surely finish it. ABC UK is a flagship company. This company is the legal owner of a trademark. They conduct R&D services, they fund that, and in terms of that they have developed an IP which they are the legal owners. They assume all risks in terms of that IP. They have a downstream company which is the Indian company. It's similar. You can completely visualize it on the basis of what LG has done. But we'll just come up with a few thoughts. ABC India pays a royalty of 4% on the trademark technology used. It also pays 4% cost plus on the raw material that I import and I manufacture the products. Third bullet is just a statement, and it is important to be kept in mind. Apart from the arm's length payment for raw material and royalty, there is no other payment or there is no other transaction which ABC India makes to its AE. So on the reverse, I just have 2 transactions. I pay royalty and I import, and I pay cost plus on the raw material. ABC India imports the finished goods from ABC UK for distribution in India, for which I am an entrepreneur. Now, this entire concept of marketing can be divided into 4 parts. I'll just give you a little a chart. And why I give you this chart, because in one of the cases after LG, in the case of BMW, they are trying to slightly distinguish how a compensation in relation to a marketing intangible can be paid. Do I strictly restrict myself to the fact that I need to be reimbursed, and that reimbursement has to be a top up with a cost plus, or there has to be some, even if I am doing a service? Or can I say that if I am earning more at the entity level, I am duly compensated for the extra cost that I have incurred on my marketing and publicity expenses? And that is where I will answer the questions that I have taken. They have taken 4 questions, and I have tried to distribute and analyze and that is how I have understood how marketing intangibles should be taken in. Now here, my margins, what is important is I am earning 16% as my margin on import of finished goods, as against the comparables 3.5%. On advertising and marketing, if you see the last chart, I am spending 17% as against 8%. So, in such a situation, irrespective of how I am characterized, whether I am an entrepreneur, whether I am a limited risk distributor, whether I am a normal distributor, or whether I am a marketing distributor, that is how these four aspects of marketing intangibles are highlighted, and very quickly I will take you through all the four. In all these situations, let us forget the situation for a moment. Even if it is a transaction that leads to marketing intangibles, if I am earning 16% vis-a-vis 3.5% of the comparables against spending 9% more on marketing intangibles, am I required to be compensated for 9%? Should I be reimbursed? One, or should I be reimbursed with a top up also, in spite of the fact that there is a difference of 12.5% at the entity level that I am earning? So even if I'm spending 9% more on intangibles in terms of marketing, which they try to deem as an international transaction, I am already very well compensated. I have already earned. Now, if I then go on to the questions one by one, in respect of manufacturing operations of ABC India, whether ABC India is contributing in the development of intangibles in India? If yes, who is entitled to the returns on such intangibles? Just to make you remember, I am a manufacturer here also, I am a distributor also. So I am distributing what is being sold. I am paying 4% royalty for using the logo and for the technology, 4%. So I use the ABC logo in the products that I manufacture and I sell. Now, in respect of a manufacturing operations, here what I can characterize myself as, I am an entrepreneur. If I am an entrepreneur, I am manufacturing here, I am having all the risk in terms of what I am marketing. I spend on my distributors, I spend on my marketing in India, and I keep all my rewards with me, irrespective of the fact that there could have been an indirect benefit to a third party, which is my AE. I feel that in terms of an entrepreneur, the concept of marketing intangibles should not arise for one basic reason, that if I am an entrepreneur, I become a complex party. And if I become a complex party, then I get out of transfer pricing, I cannot be benchmarked. That is one. Even if, assuming I am taken as a tested party, in terms of the earnings that I have already done as an entrepreneur, 16 or 17 vis-a-vis 3.5 and 17 versus 9, I am equally compensated. So even if a third party benefit is there, doesn't make a difference, I need not be compensated. Lastly, how do I compute the benefit that he has got? LG does make a statement against us, but it does not finally lead to a situation that if there is a benefit, what is that tangible benefit? How do I earn that benefit? How do I compute that benefit? So the answers to the first question is that if I am manufacturing, I am an entrepreneur, I have all the risk, I have all the rewards. Even if I am making a spend more than what I am required to, I have sufficient, all my risks and rewards are there. Hence, there are no marketing intangibles outside. Getting into question number 2, in respect of distribution operations of ABC India, in case ABC India contributes in the development of the brand, whether such non-routine marketing functions can be considered as a service provided by ABC India to ABC UK. If yes, whether ABC UK needs to compensate ABC India for such non-routine AMP. Now, the concept that has been brought about in terms of bright line does say that if you are spending more than, and that's what LG says, if you are spending more than your comparables, then to that extent you have spent on the brand, and that spending of the brand is deemed to be a service provided to the associated enterprise. How does it function? I've already said that it's difficult. I can't visualize the situation even as an accountant. Less said about a litigator. As an accountant, how do I compute that? So it's completely foreign to me. How does it happen? Now this is the last part which is necessary. Does the characterization of the Indian company have any impact in your decision for question number 2? Now there are 3 categories that can happen. One is that of a normal distributor. So if I'm, in terms of 2, if you see, it is basically not in respect of what I manufacture, but what I distribute. So in terms of what I distribute, I said, if I'm already earning more, then I need not be compensated. But in terms of a normal distributor, basically normal distributor has his normal risks. It does not take risks beyond what is required to his returns, and whatever he incurs as cost, the rewards be with the normal distributor if he is purchasing on a principal to principal basis, and then the question of any compensation does not arise to them. It can arise in a situation of a limited risk distributor, because in case of a limited risk distributor, if I accept the bright line test, then I have a steady return on my sales. And if in terms of the steady return that I have, which may be 4 or 5%, why am I supposed to spend 9 or 10% of my sales, and what am I doing? So that difference in case of a limited risk distributor does give rise to a question open to controversy, as has been held by LG. And another concept that I understood, and there is a difference in the nature of functions, is called a marketing distributor. So I have a limited risk distributor, I have an entrepreneur, which is different. I have a limited risk distributor, I have a normal distributor, and I have a marketing distributor. Now a marketing distributor, the only excess function which the department alleges is that, one, you make certain expenses for the sale of product, and the other that they allege is to do the function of distributing for the sale of product. So there are 2 steps. One you do for the purpose of distribution. To that extent, the excess part that you are doing besides what you are doing for the sale of products results into a brand building exercise for an associated enterprise, and to that extent it is a service, and the service should be compensated. The last question is whether ABC India contributes in a brand development of ABC UK by incurring the selling and distribution expenses. This question has been answered by LG, that there is a difference between the expenditure that you do in terms of what is characterized as marketing, distribution and publicity, and what you do for selling and distribution. So if you do it for selling of that particular product, then it has to be excluded, and there is a categorical finding to that effect in LG. I could not find anything interesting in this other than the fact that I don't believe in this concept, and let's see if I'm able to argue it out sometime favorably, contrary to what LG has done.
Thank you, Kanchun, for keeping with your time. Only one small supplement to what you mentioned. One more point which we had taken after the LG's case is, if you are an independent manufacturer in India, if you are, though under your global brand, you are selling the products in India, technology is coming in India, if you have compensated them in all respects, everything has been rewards, whatever are due to the parent company has been rewarded to them, then everything what is there, it has to be kept in India. So if we maintain that what is cost and rewards, what we mentioned, benefit and rewards are to be maintained so long as I am maintaining in India. There are many advertisements, maybe of publicity, not necessarily for selling, are specific to India. So those advertisements also have to be separated out. Campaigns like Kuch Meetha Ho Jaye. Now these advertisements can't be useful to the global. Now like Cadbury's cricket matches. Now these are some of the match advertisements which we find. These are India specific or product specific. It is not for developing a brand. It is for purpose of selling the product that should be classified not as a marketing product but a selling of a product, and that has been accepted in some of the decisions. So therefore, finer aspects, as you rightly said, we need to take it up after analyzing LG, but I think we'll have to wait for the special bench to decide, and after the special bench, High Court to decide whether this is right or wrong, but this is what has been there. Now I request Sunil to quickly complete his last case study within the 5 to 7 minutes so that we can complete the today's program.
Thank you very much. So in this particular case study, ABC Inc. has received 925 crore, I'm putting it in rupees here, 925 crores from its customers in the USA for certain data processing work. It has outsourced it to its Indian counterpart here, and it has paid 900 crores. The US company has incurred 30 crores more on this particular transaction and therefore incurred a loss of 5 crores. So 925 less 925 less 30, that's minus 5 crores loss. This is the particular fact as far as the US company is concerned. As regards the Indian company has earned 900, cost is 800 and the margin is 12.5%. What the TPO does, he does not dispute my numbers. I have taken 5 BPOs as comparables. The TPO adds on one more BPO having a margin of 40%, which is double the margin of what is here, what I had taken at 20% odd. And he takes 4 KPOs as a set of comparables. He comes to a margin of 44% and makes an adjustment of 260 crores. Now, even if we succeed before the TPO in getting the KPO set out, one will still have an adjustment of 120 crores. So assuming I succeed on the KPOs going out, I'll have an adjustment of 120 crores. And assuming the one BPO goes out of having that abnormally high profit, I will still have 60 crores margin. The question is, how do we argue for a nil addition? So there are really 3 or 4 steps involved in this, and there's the 4 issues here. The first is whether a BPO can be compared to a KPO. Now, as you all know, this issue is pending before the special bench, and prior to that, there are decisions which are on the left-hand side and right-hand side that I've given here. One set of the decisions say that KPO is not comparable to a BPO. The other says KPO is comparable to the BPO. The ratio of this decision, which says KPO is comparable to the BPO, is that both these KPO and BPO come under the ITS sector, and therefore the two are comparable. The ratio of the favorable decisions is BPO is a low level of processing, KPO is a high level of processing, whether it's LPO, knowledge processing, whatever, and the two are not comparable. On first principle, we have nothing to do with these 2 companies. We have 2 decisions of Delhi Tribunal and Bombay Tribunal, wherein there were 2 activities and the web services. So they held that a non-voice based web service company cannot be comparable to a voice-based web service company. So though the 2 activities were similar but not same, it was held that 2 are not comparable. Bombay Tribunal went a step further and said 2 companies, one in SEEPs and non-SEEPs, having similar activities are not comparable. So we have these 2 decisions not on the BPO KPO sector. Now, if really one goes to the fundamental logic of this, the negative decisions say it's like saying a doctor, a GP, should earn the same amount of income as a surgeon because both are doctors, without appreciating that a surgeon is a KPO and a normal GP is a BPO. So that is something which will be tested by the tribunal, and I think on the basis of this and also taking into account the safe harbor rules which have made a distinction between BPO and KPO, I think we can argue now that BPO cannot equal to KPO, notwithstanding the fact that both are under the ITS sector. Coming to the issue of abnormal profits. One, there is a BPO which I am accepting is comparable to me in terms of functions, but it has an abnormally high margin. Here we have 2 sets of decisions. One which says that abnormally high profit companies should be excluded, the other say which should not be excluded. Quite frankly, the ratio of the negative decisions seems stronger than that of the positive decisions. Except that in the negative decisions there is a rider. It says don't go by abnormality or supernormal profits. What we have to see is not whether the profit is supernormal. What we have to see is whether the profit is abnormal. And an abnormal profit is a supernormal profit due to abnormal factors. So abnormal factors may be, for example, if I had an IPO during the year. I have merged the company which is very profitable, and there are these abnormal factors which have resulted in an abnormally high margin. If that be the case, which in our case I have written there are abnormal factors, then possibly even the abnormally high profit BPO would go out. We would yet be left with an adjustment of 60 crores, and the issue is how do we get rid of that? On this, an argument can be taken that my AE has earned 925 crores, of which they passed on 900 crores to me. If you are making an adjustment of 60 crores, what you are saying is that my AE should have paid me 960 crores. Now when my AE is getting 925 crores, how can they pay me 960 crores? And therefore the adjustment, whatever the rules say, should be restricted to the 25C. On this, there is one decision on the point, only one, which is that of Global Vantage, where they restricted the adjustment to the gross revenue earned by the associate enterprise. And this decision in a non-speaking order has been upheld by the Delhi High Court, and even in a one line has been upheld by Supreme Court. The SLP has been this thing. Now if you reduce the adjustment of 60 crores to 25 crores, then the answer would be that it is within plus minus 3% of 900 crores, and therefore no adjustment should be made. But if one really examines for a moment, we keep aside that the SLP has been rejected, on what basis, when the rules are so stringent, on what basis can adjustment be restricted to the gross revenue earned by the associated enterprise? And to my mind, we could take up these arguments and this would be relevant. For a moment, let's say if it was 929 crores. Suppose there was a scope to make an adjustment of 29 crores. Let us say my AE had got 929 crores as against 925 crores. Then I would not fall within plus 3 minus percent of 29 of 900, and an adjustment would be yet made of 29 crores. However, at that stage, can I take the argument that my AE has incurred a loss and therefore no adjustment should be made? That's the point for consideration now. Now, if I go back for a moment, we keep this aside. Let's go to the earlier example of 925 crores. Supreme Court has upheld a tribunal decision wherein they have restricted the adjustment to the gross revenue earned by the associated enterprise, and there is no law which provides for that. There is no rule which provides for that. But if you have to fit in the Supreme Court judgment, if you have to convert the judge-made law into the written law, I think this is what we can do and extend this logic even to the laws. So if one really sees section 92 says that the ALP shall be computed, that the income arising from an international transaction would be computed having regard to the arm's length price. It does not say that the income has to be the arm's length price. It is having regard to. What does having regard to mean? Courts in different connections, Supreme Court and various other situations are held, having regard to does not mean sacrosanct or conclusive. Having regard means you have to take into account other factors. A number of Supreme Court decisions on this particular point. When you have to take into account various factors, then one of the factors is that you are saying my AE should have given me 960 crores, you are telling me that my AE should have incurred a loss. Or you are saying, it's an absurd result. Therefore, if we put the Supreme Court decisions with the having regards to, we may be able to take into account the gross revenue earned by my associate enterprise. And if that be the case, that means if we can go beyond the act and the rules by taking into account other factors, then why can't the other factor also be? So though we have a precedent for gross revenue in terms of Global Vantage upheld by Supreme Court, why can't this same logic be extended to loss, for which we don't have a precedent? But the logic is same, going beyond the rules because it says having regard to the ALP. Now if you go by Morgan Stanley says that the object of transfer pricing is to prevent shifting of profits outside of India. So here is a case where my AE has incurred a genuine loss outside of India on the particular transaction. Also, if you go by the ALP definition, 92 defines ALP as a price which is applied between two independent parties. Now the moment you say the price is 960 crores or whatever it is, you are in other words saying that the third party or my AE should incur a loss in selling me these goods, which is absurd. Because no third party will sell me something at 960 crores, give me something at 960 crores when they're getting 925 crores. So it as such does not even fall within the definition of ALP. Now the DPO would argue that we are bound by the rules, and if you go strictly by the rules, an addition should be made. And there are decisions to say that if there is a conflict between a rule and the act, then the act should prevail. The act talks of having regard to, which is not conclusive, and therefore one should take into account the fact that the gross revenue earned by the sister concern is only a particular amount, that the sister concern has incurred a loss, the AE has incurred a loss, and therefore having regard to means you have to take into account all these things. Morgan Stanley says the object of transfer pricing is to ensure that profits are not transferred outside of India. My sister concern has incurred a loss. The definition of ALP is that when two independent parties enter into a transaction, what is that price? Now, when the TPO says the ALP should be a number where the third party should incur a loss, it does not fit within the logic of the ALP definition. So when there is a contradiction between the Act and the rules, then the Act should prevail. We have a precedent without all this logic in the case of Global Vantage upheld by Supreme Court, and I leave it to give you some food for thought for the weekend, that whether this logic could also be extended in a case of a loss. And to my mind, at an appropriate time, as Rajan Bhai said, we are all optimists, Kanchun said, we are all optimist litigators. I think at an appropriate case, we may be able to succeed in this. Thank you. And most important, thank you to, before I get a chance, so to the chamber, to all the participants, Rajan Bhai, Kanchun, and my team at Advaita Legal, Prashant, Sheetal, Harsh and Kirtika. And special thanks Sheetal, who is right present here, who was not there of my team. Thank you so much.
Thank you, Kanchun. Thank you, Sunil, for excellent presentation. I think all of you will agree that each one of us have richly benefited by their analysis, and not by relying on the decisions, but also giving the analysis of the various provisions and giving their thought on each of the matter. On behalf of all of you, I propose a very hearty vote of thanks to both of them. I request you to carry the
Can I just ask 1 minute? As everything has to start, it has to close. And I'm sure the purpose of the 2 days deliberation is served. As I mentioned in the introductory remark, that see the 2 days proceedings, you have almost top professionals talking to you for 2 days, and there could not be any